Hey guys, it's Dan here. In today's video we will try to understand and answer the question, should a company stay private or go public? And for that we will look at the pros and cons of both, and then we will try to answer the question, is there a great or is there a best timing for going public? So let's get started, guys. Okay, so before we talk about the pros and cons of staying private or going public, let's first define the terms. That's very important. What does staying private or going public means? First of all, as long as you stay private as a company, you are of course a private company, such as for example Hermès, which is a French luxury brand, or any kind of startup. And that basically means that you belong to private investors. Who are private investors? For example, it can be, well, the founder who founded the company. It can be any kind of venture capitalists, so big private funds who invest in startups, for example, or private equity companies, which basically do the same as venture capitalists, but for already bigger companies. So between private companies and public companies, if you want to become a public company, at some point you have to go public, either by using an IPO, so an initial public offering. I made an extensive video about it, so you can watch it if you want, or there are some new alternatives to IPOs. I also made an extensive video about that, also linked in the description below. Once you become a public company such as Apple or Microsoft, it means that you belong to public investors on the financial markets. That means, for example, public investors will be institutional investors, hedge funds, pension funds who will buy the shares of the public company on the financial markets. Now let's directly jump into the subject. Why does it make sense to stay private? What are the pros? Well, there are a few. First of all, and I named the company Hermès before on purpose, because the first reason to stay private is to keep control of your business. Think about it, it makes a lot of sense. Imagine you have grown a big family business like Hermès with the luxury brand, and they really want to keep it tight and they want to keep control of the business. And the best way to do it, well, is not to go public, so to stay private. Very simple. Second reason, which is a bit related to the first one, is imagine if you need another investor, but you want to pick the investor, then staying private is still a great option, because in this case you have the freedom to pick your investor. Think about it. Once you are going public, well, your shares are in the market, and if you want to sell shares, you don't know who's going to buy them. Maybe a hedge fund who has a very short-term approach, maybe a pension fund, you don't know. So and usually in some industries it's super important, especially if you want to have a long-term vision in your company, to pick carefully your investor, especially if you are in an early stage of your business. Then of course, as I mentioned before, between staying private and going public, there is the IPO process, initial public offering, and the initial public offering costs a lot of money. So if you stay private, you avoid huge costs of going public. To give you an indication, of course it depends, but it's roughly 7% of the proceeds, which means basically if you decide to sell your shares, let's say for 10 billion on the stock market, well, it's going to be 7% of these 10 billion. So we are always talking about a big $1 million sum. So that's quite amazing, and that's why a lot of companies don't go public, or not early, because it's super expensive. Then when you stay private, and think about all the startups, as also the bigger startups, for example Airbnb, by staying private you have more space for innovation and for risk. Think about it, as long as you stay private and you have a long-term private investor behind you, he's gonna put less profit pressure on you, because maybe he wants to expand the business model, scale up the business before being profitable. Once you become a public company, there's going to be a huge pressure for making profits, of course, and cash as well. So that's not the case as long as you stay private until a certain degree, of course. Then in this case, and this is also what I just mentioned, it's a more stable environment to stay private, because you have less market fluctuation. What is happening on the stock market in 2020 or in 2008, at least at the beginning of the crisis, while the stocks are going down and there is a lot of panic because there is a lot of fluctuation. If you are in a more long-term approach, if you have a good private investor, it's going to be less complicated for you here. Crisis, it's always a difficult situation, of course, for any kind of business, but in a private business, you have less market fluctuation going on here. And the last point for staying private is you are protected from short sellers that operate on financial markets. What are short sellers? And that's, by the way, that's the reason, for example, Elon Musk, the CEO of Tesla, wanted to go private again. His company Tesla is public and has been attacked by a lot of short sellers. What are short sellers? Well, basically people, investors who are betting on falling prices. So there's an entire mechanism. They are borrowing shares and then they are buying the share when the price is cheaper. But that's not the point. The point is actually, as long as you stay private, you have more control, obviously, who is buying your shares, and you are protected against these short sellers here. So now let's talk about the pros of going public. So now, why are companies going public? What's the big point behind it? Well, first of all, and the most important point is gain access to fresh capital on the financial markets. That's the biggest reason why companies do all this, do IPOs and go public and take all that risk. It's to have access to fresh capital. Think about it. When you use the traditional way of going public, which is the initial public offering, you're going to do a roadshow to investors, and your investment bank will help you. That's why you pay them. And you will be able, hopefully, if it works well for you, to achieve a high valuation, which means that you will be able to get a lot of new fresh capital, which will help you with your future strategy, products, services, and so on. So the first one is absolutely huge. The second one is also important. Diversify your shareholder. Think about it. As long as you are a private company, as I mentioned before, you are picking your investor. Maybe you are the investor, maybe you have other investors, several investors, such as different venture capitalists. But usually it's not a very diversified, investor base. This is, of course, changing when you are entering the public market, so when you're entering the financial markets, because everybody who is allowed to buy shares on the stock market, so basically everybody, can buy shares of a public company. So you will have a very diversified investor base, which can be very important because you do not depend on only one. Then there is also excellent opportunity to cash out for early investors. That's super important because imagine the founders of Facebook, for example, Google, and all the big tech companies. Usually the CEO, who was the founder of the company, remains as a CEO, but he has cashed out, and all the early investors are cashing out at the beginning of the IPO. That's why they are so happy, you know. And the thing is actually, of course, when you're going public and when you are deciding to sell shares to the financial markets, well, this is where you are cashing out, especially if the IPO is overwritten, which means you have more people who want to buy than necessary. That means usually a very high price, and that's of course a great opportunity for the founders and the early investors, to cash out. That's also a very big part, and that's why, for example, Uber went public. And then, of course, it's also a great opportunity for growth, because think about it. Once you're in the financial market, and I think Tesla is a great example here, and once the public has understood your product and likes your company, likes your style, likes your story, well, then you basically have endless opportunities, because especially growth opportunities, because Tesla will never run out of cash as long as investors like their products and services, and especially the future returns they are promising. So this is also a very important point. So now that we have talked about the pros of staying private, the pros of going public, Well, is there a great timing? Is there a best timing to go public if you want to go public? Let's find out. Usually an initial public offering, so the company going public, well, they become successful when two things happen at the same time. One is linked to the market itself, and the second one is linked to the company itself. So let's look at it. The first reason is when financial markets have appetite for initial public offerings, meaning for new companies going public, then usually it becomes, or you have greater chances to succeed as a company. I give you an example. 2020, for example, you see a lot of IPOs going on right now because it makes a lot of sense. There is a lot of money in the market. Due to the pandemic, the central banks have put huge amounts of money in the market, and the investors don't know where to go because the interests are very low. So they're going to risky assets such as real estate and financial markets, such as stocks, for example. And that's why right now they have a huge appetite for new stocks. So 2020, especially end of 2020, great year to go public. Different example, exactly the contrary. 2008, for example, was the beginning of the financial crisis. This was one of the worst years for IPOs because there was a kind of a cash crunch and huge crisis going on, so no investor wanted to pour a lot of money into new startups or new companies that just went public. The second reason why for the best timing to go public is related to the company itself. It's when you have an appealing growth story and show a path to profitability. These are two things that are very important inside. First of all, of course, you have to have a growth story. Think about Tesla, for example. Make the transition to a sustainable future and all these kind of things. So this is the kind of growth stories you want to hear because you want to have a lot of demand in the future. That's the first thing investors look at. And second of all, often a little bit forgotten, especially these days, but you have to show a path to profitability. And here you have a very good example. Tesla was able to show to the public markets a path to profitability. They made a few profits in the last quarters. That's why they're super hyped at the moment. Investors love them. And the example against it would be Uber, for example, which never was able to make profits actually since the beginning in 2009. And they went public 2019 because they needed cash and the investors wanted to cash out as well. So they went public, but actually they never made profit so far. So investors are really questioning the business model right now, and that's why a lot of investors dropped the shares and the price went down since basically 2019. It went up again, but not for the same reason. So now that you know all that stuff, I wanted to tell you that I post once a week every Sunday. So if you like market finance, corporate finance, stay tuned every Sunday. Make sure to subscribe, make sure to like. It takes me about 7 hours to do all this video and research. A like is like 1 second, so if you like it, I love it. Thank you very much. Enjoy your week. Bye bye, guys.